Unfortunately, we could not have a physical class to actually meet each other. And we were hoping to have this revision class also physically, but given the situation, not in a position to do that. I think Nishanta would have touched last week that we are going to have the exam on the 21st of February. Your assignments are with us. We plan to give you the marks for the assignment as well as the final marks all together. We've almost completed the correction of it. The aim of these two revision classes from myself, that is today and next week, is to spend much time as possible clarifying any doubts you all might have. So I have given you all some questions already, which are from the past papers and what you've done already. But instead, I'll go through that. But instead of that, also I would like to also spend time to go through the presentations we did or the content we did in brief. So I'll switch between the questions and then go through the questions. But we'll also go back to the presentations themselves and try to understand the concepts behind what we want to sort of learn, and also then try to sort of answer any other questions, concerns, doubts that you all might be having. So with that, what I've sent you all is about 29 or 30 questions roughly. I don't know whether you all had time to actually go through them or answer them, but let's just have a look at them. Like I said, there is no particular order. What I want to try to make you understand is, look, the basics. There are two sections that I will be touching on, as you know, the treasury management side of it and the ALM side of it. So the first part of it, this is all mixed up, and you can obviously, there's no right or wrong answer, but we will use it as the purpose of it is not to get right answers as such, but to try and understand the concepts behind it and learn through that. So with that, I'll start off. Any questions before we start around the program, around anything else around it, around the subject area? Let's spend a few minutes clarifying any doubt you all might have. Any questions from you all? We have 25 people who are logged in at the moment. Any questions about the exam? Any questions about anything else? I think Nishanta covered some of it last 2 weeks ago when he started the sessions for this year. Okay, so if that's the case, I'll just jump right in. Basically, first question is to start things off. A treasurer wants liabilities and doesn't want assets in the 1 month sector. He should do what? So let's start off with a basic question. What are liabilities and what are assets when we talk at it from a banking perspective? Very simply, what are liabilities and what are assets?
Liabilities are the deposits taken by the customers. Assets are the loans given to customers.
That's right, exactly. So basically, what's the question here? If a treasurer wants liabilities and doesn't want assets, in other words, like you said, this is who's that to answer? Ruchira. Hi, Ruchira. If it is that he wants liabilities, basically wants assets, and does not want, wants liabilities, which is basically wants deposits, and doesn't want assets in the 1 month sector for whatever reason, how should he put this pool? So what is the pool rate we're talking about here? What is the pool rate? When you say pool rate, what are we talking about here?
Transfer price.
Transfer pricing. Yes, okay. So it's correct to an extent, but not the complete answer. What is a pool rate? What do you mean by a pool? What does pool mean? So basically, a pool is, in other words, we will use for a portfolio. In other words, you don't look at each and every deposit in isolation. You will take your whole bunch of deposits, bunch of assets, take it in different forms into certain time buckets, as you might have it, or tenors as you all have learned when you go through it, and then decide on, okay, for the 1 month pool, I have X amount of deposits. Basically, I have taken deposits at 5%, 6%, 7%. I have 100 million, 200 million. You'll have a weighted average sort of rate that you have, which is more or less the pool rate for that particular month. You want to do it by 10. So then you have an issue where you're trying to figure out, okay, the pool rate for 1 month deposits that I have is, right, currently I have 500 million deposits and 500 million, 1 billion assets. Now you realize that you don't want any more assets because you're overlent, but you want more liabilities. And now you realize your average pool rate for what you have is 6%. But in this situation, is it about the rate of the existing assets that you have, or is it about the rate of the new assets that you're trying to create? What is the concern here? The new liabilities, sorry. Is it about the rate for the new liabilities you have, or is it about the rate for the new liabilities you want to create? What is the question here around? The question itself is about the liabilities you want to create, the new liabilities you want to create, or about the existing liabilities you have.
Interest rate of the new liabilities that we need to create.
Exactly right. So, in other words, he doesn't care where he has the existing. He cares. That's a strong thing to say. He does care about where he has raised his existing liabilities, but this is more around what? It's more around what concept? Around the rates or another concept we learned? What's the concept here? One of the things that treasurers have to look for all the time, outside of rates and making money, the other thing that we have to worry about for the bank's sake.
What is liquidity?
You need to worry about liquidity. So in other words, the guy doesn't care, is now in this instance more concerned about ensuring that he has liquidity for 1 month through increasing his deposits. Yeah. So in order to do that, how do you attract a deposit? What are the ways you can attract deposits?
By quoting high rates.
One of the ways is by quoting high rates. So like we discussed when we're doing the lesson, there are other ways you can do that. But you have marketing campaigns, you have incentives, you have various things that you can do. But obviously, one of the key things is to have a higher interest rate. So in this case, the treasurer wants liabilities and doesn't want assets in the 1 month sector. So if he wants liability, doesn't want assets, he has to then do what? So in this case, in this question, there's only one rate. There's a pool rate. So in other words, there's a common rate for assets and liabilities for this particular purpose, right? So in that case, the pool singular rate that he has, what does he have to do with that rate? I think you all already answered that. He has to increase the rate. Yeah. So what answer would work in this instance?
Answer A.
It's answer C.
Answer here. So he sets the pool rate above market rate. So in other words, he is doing what? He is basically, by doing that, he's increasing his chances of getting deposits a bit more than he would usually have. Now, I'll ask you all a question outside of these questions, right? This kind of strategy would work in a situation where interest rates are low or interest rates are high in the market. This is not in the questions. I'm just asking you all from your common sense knowledge. If you really think about it, where the bank can increase the rate and get deposits would work more in a low interest rate environment or a high interest rate environment. Likelihood. What do you think? So, for example, I'll give you a live example. If you say interest rates are, say, 3% now, and interest rates are 10%, and now this guy wants to go out and raise more deposits. Maximum he can go in the low environment is 4%, 3 to 4, maybe that's the maximum he can take it to. And then in the high environment, he can go 10 to 13% or 14%, let's say, for example. Yeah. Which environment will this strategy work in more? The 10 to 13, 14% or the 3 to 4% environment?
High interest rate scenario?
Exactly. Because in the high
3 to 4% low.
You're saying low. 3 to 5, you say low, Ruchira? Ruchira, right? Sorry.
No, sir. I also in the view that high interest rate.
High.
Someone else says.
Okay, so whoever said 3 to 4, any reason why you said that? Thank you for the answer. I just want to think about it a bit. That's why I'm asking the question.
I thought so because to attract the market, he has to go high. When it is at the low interest rate scenario, it's worth taking the risk. I thought in that.
Okay, thank you. So let me explain it, right? So what happens is 3 to 4% means from a percentage perspective, from absolute percentage perspective, it's a higher jump. So 1% is like almost 25% jump from 3 to 4, right? But what happens is, say you have 5 banks giving you 3%, and then you decide you're one of the 5 banks and you decide to take it to 4. Now, what will happen there is, in a normal scenario, people who are getting 3, yes, you're right, they will be tempted to go for the 4, but then they will look to see, okay, what are they giving up from moving from 3% to 4% with that particular institution? They will look at the creditworthiness of that institution. Now, for example, if all the banks are all the same creditworthiness, have the same risk profile, are giving the same benefits to the client, then you have to take in the fact of ease of moving. Like, you have to move your money from this place to another bank and then maybe set up an account there. I don't know. All those operational things that you might have to do. When you take all that into account, right, then the guy might think, okay, moving like that for 1%, is it really worthwhile? But like I said, if everything is equal and he already has his setup there, it's just a matter of him transferring money there. He's happy with the creditworthiness of all those banks at the same way, then he might switch. There is no right or wrong answer for that. He could. It's all down to the sentiment of the depositor. But if that particular bank whose increase in interest rates, creditworthiness is, or credit rating is, say, slightly lower than the other banks, right? He doesn't have the same additions that the other bank is giving, whatever incentives the other bank is giving, whatever those might be, then the likelihood of the guy shifting is less, right? In fact, there is a possibility that somebody who's paying 4%, if their risk profile has decreased, that depositors might move money away from that deposit institution to a better credit institution purposely because they are afraid that there is a credit quality issue in that particular institution. they might actually move to a higher credit quality because the loss for them is only 1% doing it from the transition. But in the other scenario where he can give 14% against 10%, it's a big amount, right? I mean, percentage-wise, like I said, it might be like 20% still from a top absolute perspective. But at the end of the day, 4% from a total perspective is still a big amount. So he might really consider, okay, risk reward. Okay, he's paying me 4% more, I'll take the risk. Yeah, I'll put money there. Or I'll open an account there, whatever you want to call it. So that risk profile also will have but the attractiveness is more. So that is why when interest rates try to go up, it is easier in most cases for people to sort of attract deposits because the amount they can play around with are much more, and there is a big differential in the rate. So currently in Sri Lanka, we are in a low interest rate environment. And currently, if you look at all the banks, if you look at the profiles, all of the banks are paying probably 3-4% deposit for 1 year, and things like that. The ability to move is maybe 1%, 2%. So if anybody is paying you, unless they're having some sort of a money market product that has a deriving a certain return from activities in the money market, plain and simple, and they're passing on that benefit to you. From plain and simple deposit perspective, all the banks thrive. So I think right now there is very little, movement of funds away for small interest rate. But in the past, when interest rates were like 10%, 12%, 30%, you could see this where certain banks were only giving 8%, while there were certain banks giving as much as 11, 12%, for example. And that could mean that people were shifting money, and you could have done it with a low interest rate environment. So in this kind of scenario, right, this particular, going back to the question, yes, he can increase the pool rate and try and see, but it will also depend on where in the interest rate cycle the interest rate cycle, the economy is at that point in time. So it's not a simple thing. Like I said, the other question that they have to ask is the credit quality. What kind of signal does that him increasing the deposit rate like that, what kind of signal does it send to the market? So if it can be very clearly demonstrated that this is a short-term requirement we have because of asset or anything like that, then of course it's okay. But if not, it can be a bad signal for that. Give me a second, please. So, like I said, just to complete that question, you have to be careful at the point when you're increasing your interest rate that you do not alert the market to the fact that it is a credit concern that is driving the interest rates up. So, can I ask you all a question? Does it mean that banks can't increase their interest rates and it's always going to be a credit concern? Beyond the market rate, I'm saying. Does it mean that, for example, if the market rate is 3, the bank wants to take their deposit rates to say 4? Is there a limitation that they have, or what should they consider when they're doing that? Where do you think the concern should be? I mean, at which point do you think the bank should be a bit wary about getting their moving their rates beyond a certain point? Where do you think, what should they be aware of? If you're sitting in a ALM now and you're the treasurer, or you're not the treasurer, you're the bank CEO or the risk person, and the treasurer comes and says, "Look, I want to take my pool rate up from 3% to 6%," right? Would you be okay with that?
You would ask the reason for the same, like
Okay, so he says that, look, I'm short of funds for my 1 month in my 1 month pool, and we are going to have a bit of tightness in our liquidity. So in order to manage that, I need to increase my deposit rate and raise liquidity from the market. That's his answer.
then we should ask, like, if you get the inter deposits as high rate, in what rate you can reinvest it?
Okay,
Otherwise,
what he's saying will be that, look, it's not a reinvestment issue. It's more to do with liquidity, where we need the funds. We need to fund our existing asset book. And our existing asset book, we are going to be short on liquidity. We are going to short on our reserves. We're going to short on, our whatever other liquidity requirements we have if we don't raise the funds. So I'm proposing that we raise it from 3 to 6 so that I can actually get the funds.
If all the other alternatives of borrowing at a lower cost, then bank has to borrow at the higher from the public.
Okay, fine. Any other answers?
If the bank decide to give more rates, then
Sorry, if you can speak up, I can't hear you. Sorry.
if the bank intend to increase the borrowing rates or the deposit rates, that mean other depositor will be concerned about why they are going to increase the rates.
You mean
Then,
the customers of the bank will be worried, right?
yeah.
Okay.
In that case, there will be a possibility to premature withdrawal from the deposit side.
Okay, fine. Thank you. Any other answers?
if we need the money, like if the market rates are very low, we can get it done from the market without going for the market. Why need to we go to the customers? If the market rates are low,
Yeah, so when you go to the market rate, how do you, okay, so thank you. Any other answers? I'll answer all that. Okay, so all right, all a good question, good answers and good arguments. So if you look at the last thing, if I take that, if you look at the market rate, see, to borrow in the market, you have to have one of two things. You either have to borrow against your existing portfolio of debt, meaning corporate debt or your government securities, or in some cases, people will take their existing assets and factor it with somebody and borrow against that, something like that. But if you don't have those and your assets are like loans that you have on your book at the moment, and forget about the factoring and putting those aside, but simply that, right? Then if for you to borrow, you don't have a security to borrow against if you don't have treasury bills. If you have invested in treasury bills, you can reverse repo that and borrow against that. You can repo that and borrow against that, basically. That we know. And that you can fund on an overnight basis from the central bank reverse repo window, whatever that rate is, if you have a liquidity. If your other options to borrow in the market would be you go out and borrow from an interbank counterparty or somebody else who you have limits for. Now, you're 100% right. If the money market rates are cheaper or more accessible, you should go and get that. But there could also be limit constraints where you are tight on your limits with counterparties that you can borrow from. Yeah, you can even borrow from the swap market where you swap your foreign currency for foreign exchange to the foreign exchange swap and generate rupees through that, and which you use to fund your existing rupee book, basically, if you want to call it that. There are options there, but I think what happens after you exhausted or you're short of limits is that you want to go and borrow from your deposit. That's one thing. Second thing that you have to also understand is the deposits and assets are the one of the core operations of the bank, fundamentals of the bank. That's one of the main things that banks do, borrow and lend. So once getting a depositor to put money in the bank, it's not a short-term thing you're talking about. Money market funds in and out are very short-term. It's only for that purpose. with the depositor bringing money in, he also brings in, other business fee related business and FX related business, etc. to the bank. Right? So increasing the deposit rate and bringing somebody into the bank as a depositor would also always be considered a more long-term thing, because the depositor also brings other stuff along with it. But you're right, if it's a short-term liquidity requirement, yes, the question should be, can we borrow this without taking it from 3 to 6%, like I mentioned, which we could signal a massive sort of a credit issue. You should make sure that you've exhausted every other source of funding before you get to that point. And when you get to that point, the question should be asked is, do we have any other choice? Is this the way we want to go? And if there isn't a choice, you go for it. But it'll stick out like a sore thumb. And you have to be very careful on how you do it. Like if you look back in our own history, we've had a few cases in the past where certain institutions were paying very high deposit rates, as you all might remember. But nobody really worried about it because they had been paying that for years, over years and years and years, right? And then suddenly one day, as they call it, a Ponzi scheme, suddenly, that collapsed, and that was the end of that. But in those cases, I think, if my memory serves me right, they were paying something like 30% interest rates. We anyway had very high interest rates in Sri Lanka. Those guys were paying close to 30% interest rates, and market rates were 15, 16, or even 20%. So there was a big pickup, and obviously people were attracted to that. And that is a time when credit ratings and all that were not popular and not really done. It was a different time. So 30% means in 3 years' time you cover your principal, basically, right? So that kind of interest rate is what we saw. So that is what you have to look out for. So I think that's clear. I spent a lot of time on that, but I think it was useful.
One question, sir. Now, this when it comes to money market borrowing, suppose if bank doesn't, that particular counterparty is not a approved counterparty, there will be a risk for borrowing from such counterparty, maybe for in bank.
But
Yeah, we
not
doesn't
a counterparty. Which context do you mean not approved counterparty?
Sorry, sir.
Well, what do you mean by not an approved counterparty? What do you mean by not an approved counterparty?
Maybe for counterparties, bank would have approved board level. They would have been approved the forex money market limits. But in this case, since it's a borrowing to us, no. Then if it is not an approved counterparty, there will be a risk for Treasury to borrowing from such counterparty.
Of course,
Since it's
yes.
not approved.
I'm not sure how it works in each of your institutions, but in my institution and what I know of, if you are taking a deposit, or if you are having any sort of relationship with a client, be it institutional client or a corporate client or retail client, you have to have an established relationship with the guy, which basically means you have to have an account with him, right? An account opening process means that you have to have due diligence, customer due diligence, all the KYCs, all those done, and a proper mandated account on your systems with the relationship management, all those things. So if we are not prepared to open an account for a client, we are not then prepared to have a relationship with. That's number one. If we don't have a relationship, then the foundation of our thing, whatever we do, is not there, so we can't do anything with the client. That's. So I know there are in certain institutions probably where we don't have an active, like a banking relationship, but we do certain products or certain we sort of treat them. I don't know whether it's like an orphan account where we don't have a relationship, but we will enter into certain transactions with those counterparties. Now, for me, that is not a recommended practice, because when you, like exactly what you just said, if you have an issue with a client at a at a relationship level for whatever reason, then you should not be doing any sort of dealings with him, which basically means that, look, you should not be borrowing money from them. So borrowing money has its own risks as well. Although you think you're taking money from him, so therefore the risk is the client's and not yours because you are having the money. Say, for example, these are all on demand. Remember that, right? So if he gives you ₹1 billion, yeah, for 1 month, and then suddenly you have gone and matched your portfolio and done your liquidity calculations and all your balance sheet based on the 1 billion. And then you suddenly have an issue that comes up with this client. And that's the very issue that you all wanted to avoid by having a relationship with this client in the first place. He comes tomorrow and realizes, and this guy says, no, I want to take the money out. I want the money back. So, of course, there could be penalties, there could be, early payment fees or early withdrawal fees. All that could be that. And that guy doesn't mind. He says, look, I don't care about that. And you might even decide you want to, how you want to manage that. Anyway, end of the day, that money is his. You have to give it back to him. Immediately, if there's liquidity crunch in the market and he decides he's going to take the money out from you, you're with a 1 billion hold. Now, you thought you were the guy holding on to that thing because you had the deposit. But in reality, he can always take it back. Unless you're not willing to give it back to him, which then can be a bigger issue for you. Yeah. So, I would say that if you are going ahead with any sort of relationship, any sort of transaction, that has to be a client that is somebody that the bank is comfortable, institution is comfortable to deal with in the first place, and not something that you would do on a ad hoc basis. At least, even if you are looking to do a limited amount of products with him, he still has to be onboarded as a client, even for that limited scope of products that he plans to do, is my view. I don't know whether I answered your question.
Yes, sir. And on the other hand, that could lead to this. Say, suppose if we borrow money from some other bank, foreign bank, if that particular bank could have been undergoing anti-money laundering, like money laundering. This thing, we also part and parcel of that thing because since we borrow from that bank, no, that risk is also.
Yeah. So that's the thing. So there is what we call know your customer or something like that, KYCC.
Yes.
Now, depending on how, what kind of institution or person that, I'm not a FCC expert, but I'm just giving you from the knowledge I have. But if you're dealing with a person who has a bad reputation, or depending on the risk type of the client, so you have different categories of clients. Some customers can be a high risk category, some can be normal, so you have different degrees of KYCs you do for that. So like you said, if you're suspecting that institution you're borrowing from, and these are institutional deposits you're talking about, the person you're borrowing from deals with clients that have that kind of issue, then you have your due diligence have to be enhanced, basically. You have to do enhanced due diligence on that, and then decide whether you want to start a deposit or not, start a relationship or not. And there could be instances where you decline because of the very thing you just said, where you're not you have a concern about the type of clients that institution raises funds from in this case. So there could be a case like that. That's very much case. Or you could have a relationship with those guys, but like I said, ring fence the risk. You decide what you want to do with them. Maybe you want to do, for example, some sort of credit card related business with them, or foreign exchange related business with them, or correspondence bank, something to that extent where that part of the book you are not going to touch, and it's up to them you all to decide whether the other bank to decide then whether they are actually happy to sort of go ahead with that kind of relationship with you in the first place.
Thank you, sir.
Okay, I'll just skip 2 for a second. That's on ALM. Let's go to number 3. It's very simple questions, but like we did for the first question, let's just go around it and think through the concepts around it. Don't worry about too much about the answers. Just look at the theory that we learned and what we are trying to get out of it. When we borrow funds for 1 year and lend them for only 6 months, we make a productive if what? When we borrow money for 1 year, lend them for 6 months. So we borrowed for 1 year, so we have liabilities for 1 year, and we have an asset period for 6 months. Now we are saying we make a profit when interest rates fall. We get funds for the second 6-month period. Interest rates rise, we match the cash flows. So when do we make a profit on that?
Interest rate rise.
Yeah, interest rate rise.
So number C. This is a very simplistic question, but what is it trying to tell you here? What is the concept behind it?
We are creating a positive gap. When there's a positive gap, and interest rate has to move up to make money.
Interest rates have to move up to make money. Correct. So okay, that's good. But where is another? What underlying understanding is what? Are we living in a situation where things are static? We are living, we create deposits and loans, right? Are we living it? Are we creating it for a point in time? Or are we looking at the future and doing it? Okay, so let me revert that question. Previously, we were looking at liquidity. Here, we are looking at profit. We are looking at rates and how we make money on the rates, right? So what we are trying to understand here also, the answer is correct, that's fine. What we're trying to understand here also is, look, we live in a situation where it's dynamic. So when you sit in your ALM, when you sit in your treasurer's role, you're looking at a situation where you have to have a gauge of what the future is going to be in terms of rates, exchange, funding, liquidity. You have to have a conceptual idea of what is going to be. So, for example, if you are a corporate banker and you are sitting and going to give a loan to a client, what would you do? You'll go up to the client and say, Mr. Client, here you go. I have 50 million rupees I can give you. My interest rate for that is 7%. Corporate bank comes back and says, the customer can know, can you give it a 6.5%? So you decide based on your margin, where your transfer pricing rate is, all that, your return thresholds, okay, I'll give you 6.5%. And then if you're creating short-term assets, 3 months, 6 months, 12 months, you give it to the guy and then it's done, right? If you're creating long-term assets like for 5 years or something like that, okay, that will stay on your book for 5 years, so you have a more long-term perspective, right? But you know, most often what you're looking at is a point in time. What can I do to give my client this particular product, lending, and how much money will I make for the bank by doing that, and what kind of returns, and that's it for the year. Most often, that is it. You're not too worried. Of course, if your client is worried, then you get worried. But in most terms, you're not too worried about what happens with the interest rates after you've given the loan. Yeah. So you've given it the guy at 7%. He takes it. He goes off. That's it. You go to your next loan, right? Yes, you might have a discussion with Treasury about fixing the rate if the rates are going up, but that is more to do with the treasurer. So the treasurer has to worry or not worry. One of his key things is to be in touch with the macroeconomic situation and what's happening in the external market. It has to be a dynamic process where he's always reviewing his book and say, okay, this is what I need to do. And obviously his contribution to ALCO reflects that. But also from a trading perspective, from everything's perspective, he has to be aware on where the interest rate cycles are and what's going to happen next. So that is something important to understand here, that we are not, treasurer's role is not a static role for that point in time. It is something that he needs to be constantly aware of the situation outside and how he needs to optimize this. Yeah. Is that clear? Any questions? Okay. Let's skip the 4 for a second. Let's go to 5. Okay, let's go to 6. More interesting one. Liquidity versus illiquidity depends on whether you have what mismatches. What does liquidity versus illiquidity mean?
Maturity mismatch?
Exactly right. What is maturity mismatch?
It's the difference between the maturities of the assets and the maturities of the liabilities.
Very good. And if that is there, why is it that? Why can't we just borrow a deposit for 1 year and lend also for 1 year? It's simple, right? Why would that be the case?
If that is the case, we are not in a position to make a profit because based on the market development, we have to adjust our balance sheet.
So one of the reasons you're saying is profit orientation. Okay, good. Another reason? One reason you will purposely have a liquidity tenor mismatch is due to your intention on rates and making a profit. Fine, good. What's another reason? Why would you purposely be, say, illiquid in one tenor, and then depend on liquidity from the market for that particular tenor, for example? Or why would you be excessively liquid in another tenor where you want to be sort of over borrowed or something like that in that tenor? Okay, I'll put it this way. In this current environment, okay, like you said, you have profit orientation on that. Okay, if you were a bank and you wanted to borrow, right? What would your ideal situation be? What tenor would you borrow at now? Where would you increase your liquidity? What would you like to do now? From what you just mentioned. Sorry, who answered the first question? Who answered the question just now?
Yeah, Ramanayaka.
Ramanayaka. So Ramanayaka, to go back to you, if you, for example, say that you want to make a profit orientation on, you think you use this for profit purposes, you want to now increase, you want to use this current interest rate environment, and if you want to capitalize on it and increase your liquidity as well as profitability, what would you ideally be doing? What tenor would you be doing what for now? Current interest rates are 3%, 4%, 5%, like that, 3 to 5%. Using Sri Lanka as an example.
You would borrow for longer term and you would lend for shorter term.
That's right, exactly. So, for example, if somebody was willing to give me a 5-year deposit at 5%, I'll be happy, because for example, your view could be that interest rates should go up in the future. So you're happy to pay 5% to a depositor for 5 years. But in reality, what would happen? If I ask any of you on this call, would you go and put a 5-year deposit for 5% at the moment? If you're in the US, you might do it for dollars. But Sri Lanka, where you're used to 10% or high interest rates at this current, maybe that mindset will change. So that's a different thing. But right now, would any of you go and put deposits at 5% deposits for 5 years, 5% per annum? Would you go and deposit at any bank? I would, just to answer the question myself. So what I'm trying to say here is that, yes, that would be your ideal situation, but does not mean that it will always work that way. Yeah. So yes, ideally you will want to raise as much deposits as you want and be as liquid as you want for 5 years at these current rates. So you will go and ideally your liquidity should improve massively by, because that's what you want to do. But unfortunately, it will not necessarily happen that way. And in this current environment, you probably have more short-term liabilities than you will have long-term liabilities. Now, what happens to asset book? You just mentioned that you would like to lend at a short-term, correct?
Yes.
Okay. But what would your client be wanting to do, ideally?
They need to get the long-term borrowings.
Exactly. So you might have people at certain interest rates, maybe 6%. If they might say, look, the long 5-year rate, bond rate now is at 5%. I want to borrow from you when I can borrow at like 6% or something like that. As you know, right now the government has regulated mortgage rates. Mortgage rates are up to 5 years, I think 5 years or 7 years, fixed at 7% if you're lending on a mortgage, for example. Now, basically that means that somebody would want to come and say, look, I want 5-year fixed at 7%. Or 5-year fixed at whatever the rate at the moment. I don't want to borrow short term if I can borrow long term at 7%. Now that doesn't mean the bank, ideally, going by what you just mentioned, would like that, because if the bank's view is that interest rates are going up, right? They wouldn't necessarily want to have an asset on their book at 7% from that profit orientation concept, right? So then what happens there now? Now the issue is, there are conflicting requirements between the bank and the customer. What the customer wants to do is not what the bank wants to do. Actually, both of them want to do the same thing. That's the issue, right? So in that kind of environment, there will always be liquidity mismatch. There will always be illiquidity. So most often, when there is sort of a difference or the same opinion by both parties, therefore they want to both do the same thing, you will have this liquidity mismatch. In this current environment, you will have most depositors lending to the bank short term and wanting to ideally borrow long term, and the bank wanting to do the opposite, basically. So if that is the case, there will be liquidity crunches. So right now, you can probably see a situation where people are taking money out of their deposits because it's not worth keeping it at 3-4%. They're probably looking at investing it elsewhere. And if people who don't have deposits, looking to borrow from the banks to raise more deposits at current interest rates. So the banks are now challenges. How do we raise liquidity short term or long term? And create manage this mismatch. So they have to look at the various ways of doing it. The tenor mismatches you have is to match it. You either have to look at debentures or maybe go into the equity markets and rights issue. That's a different thing, but basically you have to find other means of raising liquidity until the markets are conducive for you to switch it around, basically. So tenor mismatches cause it, and tenor mismatches is something that you can't prevent because of what I just explained to you as well. Any questions?
So in this scenario, I mean, the depositors and the bank want to, I mean, they don't go in the same way. Is a floating rate is a solution?
So the rates are anyway floating, right? So for example, what you get now, you get tenors, right? You get from 1 week, overnight 1 week, up to 5 years, depending on the type of instruments you use. So floating rate can always be used. So somebody comes, money market rate is technically a floating rate based on tenors. So when you say those floating rate is, if everybody is going to put deposits and borrow all on an overnight or 1 week basis, then we won't have this issue. But that will not be the case, isn't it? I mean, if you look at the situation, nobody's going to borrow and lend. Everybody's not going to do float. Majority of what happens in the local market is short term. It's below a year. Very few people would actually go long term. Why that's also is because the banks don't necessarily lend long term. Banks will borrow long term, a lot and deposits after 5 years, but you will very rarely, unless it's against mortgages, see banks lending for a very long term. Their credit requirements to lend, say, up to 7 years or 10 years on, say, normal personal loans outside of mortgages without security will be very tight. So you will have that issue coming up. But mortgages can always be looked at. So to answer your question, yes, if everybody is floating short term, then that's fine. Then everything is, moving along nicely. But practically, it won't happen that way. You will always have tenor mismatches. Even if it's not to your clients, you will have tenor mismatches because of your, say, treasury bill portfolio or corporate debt, whatever portfolio. Because you could, for example, you could have raised money at 4%, 5%, and you could have a treasury bill that is 6 or 7%, say 5 years. So you could want to take that short-term money, invest it in a long-term T bond, and basically fund that bond with short-term interest rates being low, making a 2% margin while doing that, for example. So that mismatch has to be funded. And you don't want to go out and buy a 5-year bond and borrow 5 years. One, because I just mentioned, you might not be able to raise deposits for that tenor. Two, you might just have to pay up the curve and pay the same. So why do you want to pay up the curve on that? So if you're trying to make use of the shape of the interest rate curve, then you just need to borrow short term, lend long term, and create the mismatch and then fund the mismatch basically for that tenor. You don't make money on a perfectly balanced book, but you manage your liquidity if you can do that.
When it comes to gap limits, like most of times the gap limits are minus limits. That mean asset. Is it like is it the market practice so being negative gap limit set or some rationale behind?
You're saying when you say negative gap, there are more assets than liabilities, is it?
Yes, most of time I have seen most of gap limits are negative.
Meaning that banks have created more assets and are taking liabilities on a short term. Is that right?
Yes, yes.
Okay. So that again doesn't have to be the same. It'll all depend on the rate environment, like I mentioned. So if you go back, say, 10 years, our interest rates were 20%, close to 20%, right? Banks gave deposits at 20% for 5 years, per annum for 5 years, right? So at that time, banks did not want to lend long term. You don't want to lend, then have an asset on your book at 24, 25%, right? But they were forced to borrow at 20% from the market because there was liquidity issue. So in that kind of scenario, you would have had hugely positive gap in that case because you will have assets for getting the rate on your book at 20%, but floating liabilities at the short end. Yeah, and at that time the banks, it was a unique situation where they were paying high interest rates to get deposits, but obviously they were not happy with the rates they had to pay, but they were forced to pay because they needed the liquidity more than worry about the rate. But they didn't want to go out and create, they would have loved to create assets at 24% also, I guess, to an extent. But they couldn't because nobody would borrow 24%. So their gap requirements there were not negative. But it is more or less determined by the bank's own risk requirement at that point in time and where interest rates are at that point in time. If the bank is having a difficulty raising deposits, yeah, then and creating assets is not a big deal. Yeah, you will always have that. And maybe that is the reason why, because if you find the last maybe 5 years, 4 years, you probably have a situation where in the last 2 years at least interest rates have been coming down. So nobody would have wanted to put long-term deposits in that period. Yeah, and you will have a situation where people would have wanted to borrow more at least up to 1 year, and that's probably why one of the reasons you see. But there is no particular. It's very much driven by the market and the bank's own book at that particular time. How successful they are in what they do.
Okay.
Okay, any other questions? Okay, so let's look at number 7. The central bank of each country usually mandates that a certain percentage of each bank's commercial deposit be retained in liquid assets. These funds are called what?
Statutory reserve. Statutory reserve.
That's right. And why do we have that?
To control the money supply.
One reason, yes. Another reason?
Inflation, to control the inflation.
Inflation. So money supply would basically be the inflation may be a derivative of money supply. So it's the same thing. That's also arguable, but we leave it at that. Other than that,
Maintain liquidity.
yeah. It's also a way the central bank uses to give comfort to depositors that look, every $100 100 rupees that you rent is not lent out like that to outside. There is a percentage, 10% or whatever it might be. Now it's very low. That is kept aside as reserves, and the level of comfort the central bank has in the ability of the banks to pay their depositors if there's a run. But main reason is what you mentioned earlier. It is also to show how much of liquidity they are happy to pump into the market because of the way money supply or the multiplier effect works in the market. Where so if a bank wants to, for example, or if a central bank wants to increase liquidity in the market, what would they do? They would bring this SRR down as much as possible so that the money in circulation, M2 in circulation, will be more, and basically people will be able to access more liquidity through the banking system. Now, does that mean necessarily that liquidity that's pumped into the market gets taken up by clients? or serves its purpose? By reducing the SRR, you increase the amount of money in the circulation in the market. Do you all agree with that?
Yes, sir.
Okay. So does that increased liquidity often mean that it serves the purpose and there is activity, economic activity created because of that?
I suppose no, sir.
No. Why do you say no?
Because at the other end, banks should be prepared to lend the funds at a reasonable rate. If not, the objective won't be met.
Okay, good. And then there's one more part to what your answer. Your answer is correct, but there's one more part to that. Okay, so you're right. The bank has to be ready to lend it at a rate, and the credit appetite has to be there to give it to a client. Yeah. The other part of that is the client himself. There's economic sentiment, and the client itself has to be conducive for them to borrow. So, in other words, if the client is looking to, he's doing an import-export business, right, and then suddenly he wants to borrow some money from the bank in order to facilitate those goods that he's trying to buy or sell or whatever it is, right? Bank is not ready to lend. Obviously, there's liquidity. The bank is not lending, so that doesn't help. Bank is ready to lend, but the guy doesn't want to borrow because his business is not doing well, or the current regulations that are there may not be helpful for him to do his business. Then what happens? Automatically, the liquidity is there, but it's not going into the hands of the consumer because of one of those reasons. So where does that money end up then? Often.
Government securities, most of the time.
So in other words, what happens is the money that comes, excess money that comes to the SRR or whatever, ends up back in the repo, being mopped up through the repo window, or being invested in T-bills and T-bonds or through the auctions. So you can gauge that, and then you can figure out basically whether the money supply has increased, and then based on that, how much of activity has been created. So when the liquidity drops in the market, that means the market excess or the money being invested in T-bills, T-bonds, repos is not, or goes down, or it's not there anymore. That is an indication that this money is now being pumped into the real economy, basically. Is that clear? It's a bit away from what this question is, but I thought it's useful for you all to try and understand that as well. So if I were given a choice between lending money to a customer of the bank for 5 years and buying a government security, so we'll give rates for that. We'll give the customer deposit a rate of loan a rate of say 8%, and treasury bill, let's say 7.5%. Okay, both 5-year tenor. What would you do? Which asset would you lend to?
Treasury bill.
7 points. So we have 1% for treasury bill. Anybody else?
We have to see the bank borrowing, the bank, the credit rating. Say if it is AAA, better to take that 0.5% extra, taking the risk.
So you look at the client's rating and decide whether it's worthwhile us lending at 8% to that particular client based on the rating they have. Okay, fine. Anybody else? Okay, so the answer to the question is something that you will have to debate based on, like you said, the type of client. So, for example, if a client is giving, you can lend to a client at 8%, treasury bill is 7.5. Purely from a rating perspective, no questions asked, the treasury bill is a better investment because risk-free, government security, sits nicely on the books, liquid asset in terms of the credit quality, and easy to sort of liquidate if you have an issue with liquidity. So definitely something that you would want to consider. And if there's only a 0.5% difference, 7.5%, okay, looks good. Now the 8% comes with what was mentioned, the rating of that client, and also the long-term relationship with the client. Like I remember what I just told you earlier. If you are making your return thresholds on a client, right, from a overall rating perspective, money you're going to make, etc., and that client brings you all kinds of other businesses as well, which is a decision that you have to make at a bank level. You're getting their credit card business, you're getting their foreign exchange business, you're getting their salaries coming from their employees to your accounts, all kinds of other business, which is a conversation you need to have with your respective business heads. Yeah, if you're getting all that, and it's not just the 8%, then you have to also think about the overall relationship impact from that particular lending for the bank. Because remember, treasury bills are definitely from a trading perspective and liquidity perspective and return perspective, really good. But from a core banking perspective and your ability to sort of sustain yourself in the long run with your clients, it is something that something that you need to consider about how you expand your business. And the other thing that you have to also look at is how much of existing T-bills, T-bonds, or whatever you have on your book. It's risk-free, yes, but it's also about diversification. It's about figuring out how much of a percentage of each asset class you have put your risk into, and how much you want to sort of diversify in terms of that. But agreed on one thing, the differential in the rate has to be there. You cannot have a situation where the lending rate to treasury bills is like 5%, 6%. You're buying treasury bills, and you're lending to your clients at the same 5% or 6% or 7%, whatever it might be. There has to be a differentiation there, unless the argument is very strong that you lend to that client at that rate. Now, there are clients that I know, where we deal on a global perspective. Their credit ratings are much better than some of the foreign countries or foreign countries. So their risk premium is very small over the current benchmark rates. The premium we charge for their lending is very, very much smaller than what some governments borrow at. So that again is purely rating based, where you have to make a decision on whether you buy a government security or lend to that particular client at perhaps a lower rate than where the lending to the particular government is basically. Okay, so we went a little bit. We will stop in 10 minutes and take a break, but let's do one or two questions before that. Any questions up to now? Let me know if this is useful or not useful. We can change things around. If you all prefer to go back to the presentations and have a look at it, I'm happy to do that. Do you all think this is useful, or do you all want to change it out a little bit?
These goods, I mean, they are covering overall aspect.
Okay. Right. Then the amount of operational reserve, number 8, and the number 8 and 9, we'll take it. What is the purpose of operational reserve and what is the amount? How to determine the amount?
Amount has to be determined by the bank internally.
Okay.
Then purpose of the operation reserve is to maintain the meet all the financial obligation on time and other meet the other operational expenses.
Okay. So how does this operational reserve differ from the statutory reserve requirement that we keep? How does it? How is it different from the SRR?
SRR is mandatory and external.
Okay.
This is internal, and the bank has to decide.
Right. So you are right. I mean, operational reserves basically are not something that is really, I would say, in my lifetime, we don't really monitor it in a big way, very honestly. It is something that the bank knows by virtue of doing business on an ongoing basis. They know how much of reserves they have to maintain. Like you said, it's not an external measure, it's an internal, very much based on the bank's own inflows, outflows, cash requirements, etc. So basically, it's something that you will determine based on your usual pattern. And finance would usually sort of project out into a certain period of time as to what your projected cash flows will be and how you are supposed to manage how you will sort of what kind of requirements you will have, and basically manage based on that. Now, what is the importance of us of knowing those cash flows? Why do we need to know it? Not for now, but for the future. Why do we need to know it? Why do you need to know your reserves? Yeah, sorry, go ahead.
To manage the correct liquidity position of the bank.
Correct. So you need to manage liquidity and funding requirements based on that liquidity. Again, boils down to the fact that, look, you then realize I need X amount of money over a certain period of time. For me to get these funds, I need to, and then you also then couple it with the view you have on interest rates. And then you also couple it with, look, what the liquidity situation in the market is. If you feel interest rates are going up and you need a lot of money for 6 months, you will try to go out there and borrow as much as you can. If you feel that the liquidity in the market is really good now, but you expect the liquidity in the market to dry up over the next 6 months, what would you do then? You'll go out and say, okay, liquidity is good, let's borrow as much as we can now because we are going to come into a tight situation in 6 months' time. To determine all that, you need to know what the requirements are from a trading, from an operational perspective, from your overall assets and liability look and feel of it. You need to have an understanding and go out and fund your requirements. But like I said at the beginning, this is very much a dynamic process you are in. It's not a static process. So it keeps changing. You need to make as much plans as possible, but you need to think on your feet. As and when things change or things look like they're going to change, you have to be able to make decisions. It's not a decision you make only at a point in time. Yes, you have the information at a point in time, but you are also trying to picture how things might be in the future when you're making those decisions. Okay. Question number 10. What are legal reserves? are legal reserves?
Which are mandatory by the central bank.
That's right.
SRR, capital adequacy ratio.
That's right. So legal reserves are not only central bank, there could be other financial institutions and, for example, not financial, but you could have Basel requirements that come in, for example, that could mandate you to allocate certain amount of reserves or whatever for your purposes. There are different things. So it's a broader concept. It's not only SRR, like you said, it's all kinds of other things that are there that basically are mandated and you have to keep it. Some of it could be bought on by, if you're a global institution, it could be bought on by regulators sitting in other countries. Some of it could be very much an onshore local requirement that you have to adhere to. So it can depend. It all depends on the type of where you are operating the business, type of business you're operating, and the regulations that you're under. So, for example, if like myself, I'm at HSBC, and you could have the HKMA has regulations for us. The Central Bank of England has regulations. We are also mandated, obviously, from the US Federal Reserve because we have an operation in the US. And then we are also mandated by the Central Bank of Sri Lanka, in Sri Lanka. So we have to keep an eye on the reserve requirements, not only that, but all the other requirements as well, from all these other institutions and their related subs. So, for example, it could be the FSA from the UK, or it could be the Department of Justice in the US, for example, if there is anything like that. So there are different sub-institutions, sub departments or association, not association, but regulators that are also could have different requirements. So there is no list as such. There could be a whole list of stuff that you need to follow, basically, when you're doing it. So, question, we take the last one. 11 and 12 question. In order to stay liquid, we have to sacrifice what? And the second question, there are 12. If the market rate is 10%, we are willing to pay up to 20. What can it indicate? So, in essence, both of the questions sort of relate to one thing. What is that? Both of the questions refer to one thing. What is that? Sorry, go ahead.
To stay at liquid, we need to sacrifice our profit. Then for second cases, if we are willing to give more interest rate, that means our credit quality has been deteriorated.
Okay. Okay. So, any other answers, please? Thank you. Thank you for that. Thank you very much.
This will have an impact on our net interest income. As Ramanayaka said, the credit rating has to be lower. To pay higher, we have to pay a high interest rate. It says that our credit rating is lower.
Okay. So you said you had to give up what? For question 11, what was your answer? We have to give up profitability, is it?
Yeah. This.
NII.
Yeah, they have to. There will be impact on our net interest income.
Right. Okay. Fine. All right. Any other answer? Okay, so you're right. The question 11 is obviously a bit broad, but that's purposely done so that we can talk about it. In order to stay liquid, yes, you might have to pay a high interest rate, like we've done in the question 12, and then yes, you have to sacrifice profitability. But in essence, in a circular fashion, you also, by sacrificing and giving up that paying a high interest rate, you are also sacrificing, or you might sacrifice, might be a result of your credit quality dropping. But the fact that you pay the high or increase your interest rate could also mean, like we said earlier, that it gives a long alert to people, and people actually take money out of the institution instead of bringing money in. So it could also in turn, that could have an effect on your credit quality by your liquidity dropping and your overall standing dropping. So it's a bit of a chicken and egg sort of situation where you might be perfectly good in terms of your liquidity. If your credit quality, you might be 100% okay as it stands. But suddenly something that is in your book at that point in time makes you want to go out and borrow money. Like we discussed in the earlier question, you have exhausted every form, money market loans, issuing debt at a lower rate, going to the government and borrowing repo against your securities, whatever those options that you have, doing swaps in the interbank market, whatever, you've exhausted all that. But you still find that you have a hole in your balance sheet that you need to plug in. For that, you decide, all right, okay, I'm going to go out and pay 20% rate. Then you're right. As soon as you pay 20%, there will be people who are immediately attracted to you. Your credit rating is still good. But there could be people who say, okay, his credit rating is good, but that's a lot for them to pay. There has to be something that we are not seeing at the moment. There is, maybe this is short term, maybe this is long term, but we don't want to take a chance. Especially if you're an institutional investor, for example, retail depositors may not necessarily take money out that way or think like that all the time. But if you're an institutional investor who has a certain amount of money in that particular institution, in that particular firm, let's take the money out of there and put it somewhere else till we know what's happening. So your rating could be good. This could be a short-term requirement. But the fact that you increase rates indicates, there could be a problem. Yeah. And that could basically mean people start taking funds out of the bank. Right. And yes, you want to stay liquid, but you find that you have a bigger problem. And then you're sacrificing not only your NII, but you're also sacrificing your existing book, your existing liquidity. And that's why it's important when you go out there and think of increasing rates or even reducing rates to the assets for that matter, right? You think about the signal it sends out to your existing depositors as much as it sends out to your new depositors that you want to attract. And you have to think on those terms. And how much of those deposits are what we call sticky? In other words, how much of those deposits that you have already are tied down and you are sure won't move out as a result of this as well. Is that clear? Any questions?
So I have one practical question.
Please do, yes.
Yeah, at the moment, sovereign rate of the Sri Lanka has been downgraded by the rating agency. Then in order to attract foreign investors, we have to pay high premium. Then in such a backdrop, what are the implications to our interest rate scenario in our local context?
Yeah, good question. And I think that's a very topical question. Let's look at it. Basically, right now, rupee interest rates, as you know, are very low, like I said earlier, 4-5%. We need to have low interest rates in Sri Lanka domestically because obviously growth has been badly impacted last year. We don't know the official numbers as yet, so we don't have that officially, but should be negative number, I feel, for last year. So with that, you need to have low interest rates in order to keep the economy going. And thankfully, our inflation rates are not very high, so you can afford to have low interest rates. And there are different arguments to say that just because, like I mentioned earlier, that because you reduce interest rates, it doesn't necessarily mean that it's going to impact inflation in an adverse way. You look at Japan, you look at the US, a lot of countries like that have had interest rates low for a long time. Europe, and of course, more advanced economies with bigger reserves, etc. But still, their inflation has been very much checked, right? So low interest rates in domestically is definitely something that I think we need to have ideally, right? How long we can sustain it is a different thing. Like what comes back to what you said. Our rating agency downgrading is obviously unfortunate for us, and that's not good in terms of when we go out and try to borrow into the global markets. And that's one reason we've not done it without having a good enough sort of a rating. It's very difficult to go out and borrow at a reasonable interest rate. And after COVID, we saw that markets are very volatile, and it was not easy to go out there and borrow. So paying usually our credit was above the benchmarks for like 4.5%. But if you look at the international sovereign bonds right now, they're trading at about average. I don't have the details with me, about 14% or something like that, 14-15%, which is very high in a low interest rate environment. And that's not because of anything. It could be liquidity in the market, people, not understanding the situation, all kinds of things, right? So let's not go there. I don't think that is something that is not something we consider. So yes, question is in terms of what will happen to local interest rates as a result of this. So we can borrow money in two ways. You can borrow money by 2 or 3 ways. You can go out and borrow money in the dollar form, in dollar ISPs. You can borrow money, I'm talking from foreign investors here, right? So foreign investors can buy the dollar bond that is trading offshore. Foreign investors can buy the rupee bond which trades onshore in Sri Lanka. So person buying the dollar bond will take on no exchange risk. He only takes on the risk of repayment of dollars by the government of Sri Lanka, whoever the issuer is, right? So when he buys the dollar bond, he buys the dollar bond 5 years or 2 years or whatever the period, gets his money paid back, he's happy, he takes his interest rates, goes. So yes, the rate will move in between, but the rate that he gets is usually a fixed rate with a coupon, so no problem. But in between, the mark-to-market will fluctuate based on the market rate. That's what's been happening now. But as long as the guy gets paid at the maturity, he's holding on to a bond, he gets his money, end of story, he's happy. But it trades on the secondary market as well. And when it trades on the secondary market, if you want to sell and get out, you're looking at the mark-to-market rate at that time. Now, that's one bond. The second bond he goes is the rupee bond. So how do you attract clients to the rupee bond market? You have to have reasonable interest rate in rupees for him to come in, and then you have to have some sort of stability in the exchange rate, because the investor coming in to invest in the rupee bond market is looking at the return he gets of a total perspective on that, not only the interest rate he gets on the bond itself. He's looking at, okay, when I invest in this, I'm getting a return of say 6%. And then when I want to take the money out, I have to sell the bond, buy rupees, take the rupees, buy dollars and take it out. What is the exchange rate I have to take from them? So in order to attract these investors into this, either you have to have interest rate in the rupee bond that is higher than what you will get paid in the dollar bond, number one. and or he needs to also have, the investors have to be confident that the exchange rate will be stable relatively throughout that period in order for him to take back the money without losing on the reconversion of that FX. So in an environment where we had 10% rupee interest rates and the rupee was not moving and the sovereign bond was trading at 5 or 6%, there was a buffer of about 5%, which is the premium that the rupee bond was over the dollar bond. And in that kind of scenario, investors used to buy it. Rupee was relatively, say, stable, happy, they invest, they take their money out. So right now, I think to answer your question, in order to bring investors here, there is no right answer. But at the end of the day, investors are raising money in dollar markets at 1%, 2%, low foreign currency, foreign exchange rates, foreign currency lending rates. Euro rates are all negative, or some of them are negative. Dollar is at the low. Anywhere in the world, yen is low, so you can raise money cheap. So yes, 5% is definitely an attractive rate for Sri Lanka rupee bond in Sri Lanka. Yeah, but then you have the international sovereign bond trading at, like I said, 14%. So the question for these investors is, look, where do we put the money? But obviously, they have to be comfortable with the quality of credit of Sri Lanka, whether it will be governments in dollars or rupees. That is where this rating agencies' concerns are coming in. And that is why, obviously, that is not the first thing that the authorities are not going for. They are going for other forms of funding, because with the current rating situation, it will be difficult to attract investors to the international sovereign bond. And in this current, even to rupee bonds, they will be a little reluctant, because when they compare 14% against 5%, it's on the other way around. So if I was an investor who is happy with the credit quality of Sri Lanka, wanting to invest on something, I will look at the 5% rupee bond. I will look at the 15% sovereign bond and say, oh my God, I might as well buy the sovereign bond at 15%. But there is a fundamental thing here. Government of Sri Lanka can't print dollars, obviously, and repay the sovereign bond. They have to have dollars to pay the sovereign bond. The rupee bond, they can repay that, because we can effectively print rupees and pay. So repayment risk-wise, the rupee bond is much safer. Dollar bond could always be something difficult. But rupee bond is not 100% secure from a repayment risk perspective, because we will pay the investors back his rupees, fine, but he still has to buy foreign exchange and take it out. And for that, he needs to ensure that he has the foreign exchange in the market, and he can get the liquidity foreign exchange to buy. So there is an element of repayment risk on the rupee bond as well. But obviously, it is not as obvious as that as it is in the dollar bond situation. So it's a challenging time, I think, in that sense, and something that requires some careful consideration, because we having low interest rates, while it's very much needed, is not helping attract investors to the rupee bond market at the moment. Or we need to make sure that we can get those international sovereign bond yields lower, closer to where it was before, 4-5%, before we can sort of then try to attract the investors into the rupee bond market. Long answer. I don't know whether I answered your question, but
yeah, got some insights, sir. Thank you.
All right, it's 10:15. We'll take a break for about 15 minutes, come back, and we'll answer some of those questions. We'll just stick on to the Treasury side of things a little bit this time, and maybe touch on a bit around that. And next week, we can look at the ALM bit. And are you all okay with this? Because if you're okay with this, we can continue like this, or on the second half, we can go through the presentations. If there's anything particularly around that area or want to refresh yourself on, let me know. Can you all hear me?
Yes, sir, we can hear you.
Okay, good. So let's start off. We'll continue with some of the questions, and then maybe we'll touch on some of the presentations if we have time. Let's look at it again. We stopped at 11 and 12. Okay, let's look at, before we get to the gapping questions, question number 14. We have granted a loan for 1 year at 30%. We can fund it for 6 months at 25%. But at the end of 6 months, we do not get another deposit. What is our worst problem? Worst problem. So let's look at it. We've given a loan for 1 year at 30%. We can fund it at 25%. Okay, good. But at the end of 6 months, we don't have another deposit. So basically, you move a lend for 6 months at 30%. What is our worst problems? There are a few problems here. So let's list out the issues that we have first. Yeah. So what are the issues we have?
We won't able to repay the customer his deposit after 6 months.
We won't be able to we won't be able to repay the depositor after 6 months. Okay, fine. That can be an issue. Yes, okay. But okay. But this question is more around, you get your deposit your matures, you give the money back to the depositor. What is your worst problem? Because think of it this way: you have only one loan and one deposit on your book at the moment. You've lent at 30% for 1 year, and now you borrowed for 25% for 6 months. What is your worst problem? So what they're saying is, can you see this? Is it clear? Not clear or clear?
Clear, sir.
Yeah, okay. So 30% loan. Deposit 25%. Yeah. So what's looking at that? What are your problems?
The worst problem is liquidity problem.
Liquidity. Okay. What do you mean by liquidity problem?
That means after 6 months, we won't be able to meet the demand of the depositor.
So you're saying after 6 months, here, you don't have any money.
Yes.
Right. So one is liquidity. After 6 months. After 6 months. Okay. What's the next problem? What's the next problem?
Rise in interest rates.
Rise in interest rates. So you're saying when it goes here, interest rates go to, we'll say, 35%. So we have rise in interest rates. Okay.
We might have a funding liquidity risk. I mean, we'll have to borrow at any cost and meet the demand of the deposit.
Yeah, so this could be a combination of both these things, no? Right?
Yes. Yeah, okay.
Any other issues? You also mentioned that you won't be able to pay your deposit in in 6 months' time, right? So that one
Credit.
would be a liquidity issue. After 6 months as well. That could result in you not being able to pay your depositors, existing depositors as well. So, okay, so that's there. Now the question is there any other problem? There could be other issues, but these are the two main issues, correct? Yes or no? Yeah. Now my question is, which is the worst one out of the two?
First one is the worst question.
First one, okay. Anybody else? Any other views? Any other views? Yeah, because I would also think first is the problem, because rising interest rates, you having to pay say 35% for the next 6 months, is a profitability issue, is a NII issue, is a unfortunate situation. That could be also because, not because of your credit, as long as it's not because of your credit worthiness and it's coming because of the market interest rates changing, you took a wrong decision, or you didn't have a choice at that time when you made this decision, right? So you have to pay it, you have to pay it. There's a negative of, whatever, 5% or 2.5% depending on the tenor. That's something that goes with your view or situation. This one is more to do with hole in your balance sheet, the gap in your funding, right? And you really need to sort that out. So you don't want a situation where that will happen. So now, looking at this environment, it looks like a very high interest scenario that we are in. Yeah. If you, when you lend at 30% and you are borrowed at 25%, as a ALM or Treasury guy sitting here at this stage, yeah, looking down the barrel, what should you be looking at doing? Should you wait for this? Should you wait for 6 months? Should you wait for 6 months? It's just a question, There's no right or wrong answer. What do you think?
Better not to wait. Before it reaches, better to.
Okay. So now you decide that you're going to not wait, and throughout this period, you're going to borrow. Say, just say monthly. Something like that. Right? You forecast your requirement and you decide to borrow. Yeah. Why are you borrowing like this? Instead of taking, okay, I'm going to borrow all the way up here. I'm just going to go out and pay whatever for the next 6 months also. I'm going to do a forward rate agreement and I'll borrow this month for this month. Or I'm just going to take a clean 1 year deposit for the remaining period. Why are you doing that? What stops you from doing that? What stops you from doing this? Again, this is hypothetical. That doesn't mean that it could be the case. I'm just asking. What could be stopping you from doing that? Doing this?
If we are to depend on a single deposit, we will not be able to manage our concentration risk on maturity profile.
You're saying that you're relying on one depositor.
Yeah.
Therefore, because you're relying on one depositor, you have a concentration risk. That's what you're saying, yeah?
Yeah.
Concentration risk. Okay. Any other views? What about the rate? Now remember, at this point in time, 25%, 30%. What kind of rate do you think he has to pay here? If he borrowed here for 25% and it's a upwardly sloping normal interest rate curve, right? Where would he pay his interest? What would he have to have paid for deposit up here? 1 year. Assumption. It's a normal interest rate curve. It's not an inverted curve. It's not a flat curve. It's a normal interest rate curve.
More than 25%.
Yeah. We'll say maybe 28%. But could be that, yeah. So what does it mean there? He's paying 30%, 30% on loan, paying 20%, 28% on a deposit, right? Now, 2% margin, is that enough? Can't say, may not be, right? So my question I'm asking you is, what is the view here? His view on rates and what he needs to pay today. So basically what I'm trying to say is he probably didn't do this on day one because he would have had to pay 28% to fund a loan of 30%, and that would not have been worth it, number one. Now, part two of that answer is, you could also have the view that interest rates are coming down, opposite of this, in a few months' time, and he'd rather monetize that view than borrow for that tenor and finish it off, right? Third thing is, right, liquidity. Meaning, again, coming back to this thing, that he could have an issue here, he could believe that right now liquidity is not good and I can't borrow here and I'm paying this rate because of liquidity also. So I believe that liquidity will improve over the next period, this period. Therefore, I'm going to wait till that liquidity situation gets better, and then I will look to fund my thing, or I will fund it here. Yes, there is a problem. There are risks, but that's why you need to have this information. These could be the reasons why he's not doing this at day one, and these are the risks he has if he doesn't. If his view is wrong or he doesn't dynamically watch it and manage. So I'll ask you another question, right? All this, his views and all that go wrong. This situation is about to happen. Yeah. What does he do then? Going back to some of the other questions we did earlier today, what does he do then?
Borrow at a higher cost and instead of.
That's correct. He has no choice, but like we discussed earlier, he has to go into the market and if he's exhausted all other sources of funding, go and borrow at a higher rate to manage his book, basically. Okay. Any questions? Right. I think we are clear on that. Okay, let's jump on to questions 21 to 30. I'll touch on the rest next week. So I just want to finish, like I said, the treasury sides of things a little bit. So 21 to 30. We'll try and finish those questions off today and answer around it. Theoretically, the treasury's position in the bank could be what? It's an open question, but we've done this before. What is the treasury's position in the bank?
Theoretically,
sorry, go ahead, please. Yes.
Theoretically, it is the internal section of the bank.
Okay. Any other views?
Fund management.
Fine, thank you. Any other views? So we have, let me put it down here. Treasury's position in the bank, and I think the rest of the questions go on to about hierarchy and so on, right? So basically, let's look at Treasury's position in the bank. You say internal. Somebody has said fund management.
So here you mean position means the functions, is it?
Yeah. Function, position, as in, for example, it's a combination of both. What is the treasury's function in the bank? Where do they sit in the hierarchy of the institution? If you look at an org chart and if you look at the importance, where does treasury sit? What is its main role?
So there are two main functions. One is managing the liquidity. Second one is managing the risk.
Liquidity and risk management. Okay, what else? So we cover liquidity, fund management, bit of that, risk management, okay. This you say it's internal, okay. What else?
Maximizing the profit.
Okay. Profit oriented. Okay. What else? What else?
It's a financial center.
I'm just writing everything down here, so I'm just putting your thoughts down. So, financial center.
Yeah.
What else? Anything else? Can you see this? I draw it in blue. Is it clear? Can you see this side? Hello? Can you see this?
Yes, sir. Yes, can see.
Yeah. All right. So basically, in a typical organization structure, what are the
Do you mind using a black color pen?
Yeah, that's why I asked, because I was not sure whether it's clear. Okay, I'll do that. Okay, typical organization structure. Right? And this can obviously change slightly, depending on how the banks manage themselves. There are three main areas. Yeah. One is your retail banking arm. Right? You can call it personal banking, retail. Some people call it retail. They call it branch banking, whatever. But basically, it refers to your individual clients that you do business with, retail clients. Right? Then you have your corporate banking, right? The corporate banking would be your large corporates that you deal with, the SME clients you deal with, the MME clients you deal with, your institutional clients that you deal with also sometimes will be there. So it could be corporate and institutional clients, basically. Both these areas, right, have client relationships. They manage clients, and they basically, retail will be borrowing and lending. These guys also will be predominantly lending, but the institutional clients they deal with, like the insurance companies and pension funds and all that, would be lending money to the bank as well, right? But predominantly asset driven. Retail will be, in Sri Lanka, I would say, predominantly liability driven. Okay. Now, Treasury sits here, and I'm not talking from, there is finance, there is audit, there is all the other legal, all those guys there. I'm just talking from a purely a business generation profit present point of view. Yeah. So Treasury, and some places they call it global markets, as we discussed. Treasury and global markets, GM, sits here, reporting independently to the Treasury. Okay. Now, what is the function of Treasury? Treasury would basically take these deposits, take these loans, or both, whatever, and they would manage the risk brought on to the bank as a result of the activities of these two sections, right? Based on the type of assets those two sections or liabilities those two sections are creating for the bank. So the risk management side of it, which you all have mentioned, internally for the bank, as you have mentioned, is managed by Treasury. Yeah? Clear? Clear or not clear?
Yes, sir.
Risk management side of it. So you could be having, you could be borrowing at, we discussed all that. So what the retail guy then has to focus on is just go out, take a deposit, pay a rate, that's it. He doesn't have to worry about interest rates going up and down. What does the corporate banking guy have to worry about? Go give a loan, get my client to borrow from me, that's it. He doesn't have to worry about the movement in the interest rates or liquidity or anything like that. Right? His decision is determined by the liquidity, but at that point in time only. After that, the rest of the problem sits with here. Okay? That's the situation. Now, then the liquidity, like I said, is handled by them. Now, funding. Now, these activities that these guys do result in the risk to the bank that Treasury manages. Yeah. At the same time, Treasury also has to make sure that it has enough of funding and it has sufficient liquidity to facilitate the business of these two areas. In other words, it has to make sure that if the corporate banking guy says, look, I need to be lending $100 million rupees next month, I need the money, please can I get it? This is not his existing book, this is his new requirements, his projected requirements. We need to be able to go out there, fund that requirement for these guys, and so that we have the bank's requirements. Same way the retail guy says, look, I need to raise deposits, right? I need to raise my book because I'm, I'm keen to get more clients onto this new platform that we are doing, a new proposition that we are giving our clients, but we need to give a higher interest rates for that. How can we structure something for that? What are the products we can use for that? So the Treasury guy then had to come back and say, okay, we can do these products for you to raise deposits. So that way, Treasury not only reacts to the business that these guys create, it also proactively engages them on the requirements they have. Is that clear? So it's a two-way thing. Yeah? Yes or no? So we've covered fund management, we've covered liquidity, we found that it's internal. Okay. So then, while doing that, Treasury by itself also needs to make a profit. Not dependent on the profit of these two sections. So this guy has a margin on his loan. This guy has a margin on his deposit. Treasury has to have, through this process, have a trading income. Yeah. Income because of the funding, how we funds and funds based on the balance sheet. And there's one more type of income trade there says that Treasury makes. You have a trading income, you have income coming from your balance sheet and how you fund it and how you transfer price it. And you have one more type of income that you make. What is that?
Direct dealing in the market.
So that's trading. Trading, when I say you're trading for your own book, you're trading for hold to maturity, or you're trading as a accrual. Without going into that, just purely from a trading perspective. The trading could be fixed income, it could be FX, it could be anything. But that's more or less sitting on the trading side. Then you have the balance sheet side of it. Like I said, by managing this dynamically, deposits and loans, you create a funding mismatch, etc. That Treasury has a certain transfer pricing policy around that. It has an income it makes on that as well. What's the third one? Third one is sales income. That is where you need to, there's a question there later on also, number 6. It is also external. So Treasury is not only internal, it is also external. Why I say that is because Treasury guys now deal direct with customers as well, right? So in other words, if a customer wants to discuss how he manages his foreign exchange risk, he doesn't necessarily talk to somebody. He will have an account here or account here, and then he will say, look, I want to discuss how I manage my foreign exchange risk. Now, these guys will not have the expertise to give him guidance on that. So what would you do? You say, okay, let me get your Treasury guy. Now, earlier, in the past, 20, 25 years ago, Treasury was focused internally. You're very right to say that. Not anymore. Because of the specialized nature of the business and the complexity of the products done, you cannot expect a guy sitting in general banking to be able to answer some of the questions that might come, which are technical. You need a technical knowledge to answer. So you need a salesperson with a GM background, a treasury background, to be able to focus, to talk to clients and guide clients. By virtue of doing that, you make an income, right? So the treasury sales guys will make X amount of income that comes from a foreign exchange margin or a interest rate margin on interest rates beyond what these guys are quoting. Different banks might have different models how they do that. Yeah. And they would basically take that, and that income will also sit within this space. And that will also mean that there is external focus where not everybody, because of conflicts of interest, because of information security and not wanting to give information ahead of time for purposes of being seen, parking positions or front running positions, etc. Sales usually sits away from the trading desk and the companies. They have some countries, they are segregated from the rest of the group. Yeah, they sit separately. There's information barriers and Chinese walls and all kinds of stuff that prevent these guys from interacting with these other guys. So that the information there, but these sales guys would work very closely with these teams because ultimately it will be the same time. In some places, Treasury has its own clients as well, but my understanding or my feeling is that most often a client of Treasury is already a client here or here as well. So basically, very broadly, those are the main areas that Treasury will look at and how they would make their profit. But you have to remember, it's profit oriented, it's external as well as internal. There's a fund management part of it, there's a liquidity management part of it, there's a risk management part of it. Financial center, yes, in the sense of it centralizes the risk and manages the risk centrally without having these two have to worry about market risk. Market risk is handled from here. So when you say financial center, it manages market risk. At the end of the day, of all the risks that are there, you have credit risk, operational risk, market risk, financial crime risk, reputational risk, all that. So some of the risk, all these guys have most of this. So we'll have financial crime risk here, you have operational risk here, you have credit risk here. Same here. Treasury has one more risk, basically, which is basically market risk, which nobody else manages, they manage. Any questions? Yeah, clear, not clear, not any doubts? Please ask. Any questions?
Yeah, so now in a nutshell, when it comes to treasury positions, how we can like define
Treasury positions. You are talking about
Yeah.
treasury position, meaning that positions that treasury takes on its own accord, not for clients, is it?
Yes.
Okay, so that comes from here. Trading. So in other words, what you're saying is, we'll take foreign exchange, for example, right? So each bank will have a net open position of X amount, and the bank is allowed to hold on to that position. Now, obviously, there's a bit more scrutiny and a bit more regulation around that now, but in a normal situation, the bank can hold on to that net open position of dollars for its own requirements, as well as the client's requirements, right? So in other words, you can have a position for the bank where You believe the exchange rate is going to depreciate, appreciate, or you're going to have future requirements, etc. And you can hold on to a position which you, for necessarily you don't have a client flow for. You might have not have importers coming to buy dollars from you, for example. You might just hold on to some dollars because you feel it's a good thing to hold dollars because the exchange rate will depreciate later and to meet future requirements. Or you could have a situation like we said of view on interest rates. And you have a surplus created by your retail banking guys in your deposits, and you have more excess liquidity created from that. You don't have enough of people to borrow from you from corporate banking, or you don't want to lend because of poor credit quality or whatever the reason might be. So you might, as a treasurer, say, look, we have excess commercial surplus from our retail, right? I'm going to take this money and I'm going to deploy these funds into government securities, for example. Yeah, and you go and buy government securities. Now that is a position created for the bank by Treasury. In order to create that position, you are paying the retail guy based on a transfer pricing. So he's happy. He's done. From that point onwards, it becomes a position for Treasury. And they manage their positions for thing. Now the corporate banking guy comes later on and says, okay, I am okay now, I need the money. Now, that guy has already deployed the money. But at the same time, like I said, because there is a responsibility, he said, okay, fine. I don't have the liquidity right now. I'm going to basically have to go out into the market and borrow that money and give you. And then we have a transfer pricing mechanism in place for that. He'll give you the money based on that transfer pricing mechanism, right? There could be a debate to say, okay, but you had the money from here cheaper. Why can't you give me that money now? Why can't you sell your treasury bills and give that? So look, sorry, that's already deployed. At the end of the day, that's why this is independent. Because, and there are transfer pricing documents in place, because to avoid that kind of debate, ambiguity, everybody knows what they're going to get paid or paid. And under what circumstances that happen. That is also why there is ALCO and a decision-making process around it, so that if there are any changes to that, any ambiguity and critical situation, that can be debated at that forum as well. Is that clear?
Yes.
So let's go through the rest of that. We've discussed 22 also. Who sets the rate? 23. Who sets the rate if the corporate manager wants to make a deal to attract a new customer? So we're talking about here. He has a customer. He wants to set a rate for the customer. So in other words, what's happened here? Is Mr. Clark customer here, Mr. X. He wants to borrow money. This guy has to know what rate he's going to give it to him at. Yeah. So simple question. Who decides the rate? Question number. Who decides the rate that this guy gets the loan at? Who sets the rate? Who sets the rate? If somebody is lending to, say you're a corporate banking manager, customer says, I want to borrow from you, 5 million rupees from you. What's your rate? Who decides the rate?
Corporate manager will decide.
Corporate manager will decide.
Yeah.
Right. Now, for him to decide that rate, what does he need to take into account?
That's a minimum lending rate.
Minimum lending rate. What do you mean by minimum lending rate? What do you mean by minimum lending rate? What do you mean by minimum lending rate? So, in a lending rate, what are the components? Very simply, I'm not a corporate banker, but what are the components that go into a lending rate? Number one,
Cost of funds.
cost of funds. Very good. Cost of funds. Okay. Number two,
Premium for default risk.
okay, so return risk reward. So what we call default premium. They say default premium. What else?
Liquidity premium.
Liquidity premium. Fine. And what else? And your margin, right? So what I'm trying to say is this return, the default premium is also what we call return on risk-weighted assets. In other words, you take the guy's credit rating, you take the amount of capital that you have to allocate based on the credit rating. So the credit rating and the capital that you have to allocate is will also, and the tenor of the loan will also determine what kind of return thresholds you have to meet. And based on your return on the risk weighting of the client. So basically, if you say you're going to lend to, say, a AAA client or a BBB client or whatever it might be, your risk weight return threshold will be higher if it's a lower risk weighted client. And obviously, if the tenor is longer, your return threshold also be high. So basically, without going into all that, basically there will be a certain minimum rate that you will charge for as a return for that minimum. Then, depending on the liquidity, you have a liquidity premium. And then above that, if there's still, if you still feel you need to start additional margin, try a margin. Most often, if you add these two in a very tight market, your capacity to charge an additional margin, because it's already built up, is maybe less. So these two returns will come in as the return overall, and you're sort of meeting the criteria, minimum criteria you need to meet. But this is not what we are talking about here. So the credit manager, along with the risk teams and all the other teams, will get together and decide on the issue. This is what we are concentrating on now, right? Cost of funds is the base at which you start at. Now, who determines that? Or how is that determined?
That is the marginal cost of borrowing.
Okay. From the where?
From bank perspective.
From the whole bank's perspective. So,
Yeah.
who is determining who is responsible for generating that cost of funds?
Treasury.
And where is it sort of documented and discussed?
In ALCO.
ALCO, right. So what happens is, in a typical daily functioning of Treasury, they would go out into the market and they would look at the day's interest rates for that particular period, 1 month, 2 months, 3 months, 1 year, whatever. And they would say, okay, today's cost of funds are this much. And they will circulate that information to the bank, to the relevant departments. Yeah. And that will give you a cost of funds if he wants to lend a 5-year money fixed for a client, but the cost of funds for that period on an interest monthly perspective, interest, yearly perspective, semi-annual perspective, whatever that might be, he will give him a strip of cash flows, basically, of cost of funds, or in this case, value of funds for retail. Yeah? This guy will take the cost of funds. Okay, this is Treasury's cost of funds today, say 5%. Then he'll add everything else and then make a decision as to when. So now the question is, who sets the rate if the corporate wants to make a deal to attract a new customer? Now remember what we're asking for here. There is already a cost of funds. This is all known, right? These are the components that he can change around that, right? So corporate manager already knows all this. Now he wants to attract a new customer to the bank. Okay. What does he do? What can he do? Basically, what he's saying is, what I have now is not good enough. I want to go out and get a new customer. These things that I have are not going to help me. What does he need to do? What does he want to do? What can you do? He will talk to this guy. I say, look, Mr. Treasurer, your cost of funds is a little high. Can you do me a favor and reduce it by 50 basis points? Then I can get a new customer, because I can't reduce this anymore. I can't reduce this anymore. I don't have a margin on it. I just want to make sure I win this new business for the bank. Yeah. But can you reduce? So the treasurer will go back and say, look, this is my standard cost of funds. This is what I can do. He will get some information from the corporate manager. How much are you trying to raise? What tenor are you going to raise it for? Are we getting any other business for that? For example, will Treasury get more sales business for that? Can I get more effects from the client for that? Can I get, will it help also? Will it help Treasurer, although that he has good cost of funds here, he might be having excess funds. And he might not mind changing his cost of funds slightly to give more money out. So it's a dynamic thing. The question can be asked. Treasurer says, yes, there is capacity. Let me do that. You can, for this particular client, you can reduce the cost of funds by 50 basis points or something like that. So it's a dynamic decision, right? The decision is made based on a standard criteria. That's fine. Often this should not be changed and this should be stuck to. But if it's a new customer and we want to attract it, is substantial, there's always a process where this can be a dynamic conversation that happens and a decision taken. Is that understood? Clear or not clear?
So what is the method to calculate the liquidity premium under this formula?
Liquidity premium. So that will depend on the bank itself. So for example, we'll say corporate banking wants to lend. They can't raise deposits by themselves, or Treasury can't raise deposits, but retail can raise deposits. Yeah. So retail says, look, if I'm going to go out there and raise more deposits for you, I have to then raise those deposits for you. And if I'm not going to use it for my customers, and I'm going to give it to Treasury and whatever, I need to get paid a premium for that deposits that I have. Because instead of going into the market and borrowing in the market, you're going to take the deposits out of these guys who then are not going to be able to lend to their customers because Treasury will be lending it to Treasury bills or whatever, or corporate banking will be lending it to their clients. So retail might say, okay, pay me additional above the cost of funds that you pay for my usual deposits. If you are taking anything above and beyond this amount, I want to get paid a liquidity premium for that. 100 basis points. Yeah. And then what corporate banking then has to do is when they calculate their loan rate, they have to add the liquidity premium to that. Now that sits outside the normal cost of funds because this is over and above the normal business that you do. Yeah. However, you can also have within your transfer pricing policy something to say, look, because of the situation in the market, right? Cost of funds will be there, but this liquidity premium will be added in. Usually it's kept out because the liquidity premium is not usually part of it unless it's a long-term lending or borrowing. Yeah, there's a long-term risk to the bank and there could be liquidity issues. Short-term, usually it's not that big and it sits outside of the risk premium. But to answer your question, the rate on that will be very much a decision taken by where you feel you can actually raise that excess liquidity or what you feel you should be paid for that excess liquidity that you are giving to a certain client. There is no right or wrong formula for that. Okay, then let's go on to the next question. Select the tools Treasury uses to achieve its objectives. Pool rate is 2. Okay. Okay. What are the tools we use to achieve this objective? So we have all these objectives, right? We've discussed the objectives in essence. What are the tools we use? What are the tools treasurers use to achieve these objectives? When you say tools, it's a very broad term. So just think about what we would do and how we would do it. Then you'll get the answer, basically, or you'll know the answer. What are the tools you will use in a treasury?
Transfer pricing method.
Okay, transfer pricing method. Okay, let me just put it down. So transfer pricing method. Okay. Transfer pricing. Okay. What else?
Through ALCO.
ALCO. Remember, we're talking about tools here. Okay, ALCO, right? Okay. I'll take it down and we'll discuss. What else? What are the other tools? What are the tools? What are the tools? Remember the question. What are the tools Treasury uses to achieve its objectives? We know the objectives are funding, liquidity, profitability. What are the tools it uses?
Effective cash flow management.
Effective cash flow management. Okay. What is? What is?
Correct call on the interest rate.
View on rates. All right. What else? What else?
Under the cash flow management, the forex also can come in. Correct. I mean the
Yes, you are saying FX here. Yeah?
FX also. Yes.
Okay. So let me go into this. So when you look at Treasury and global markets, okay, I said there are three sources of income: trading, ALM or balance sheet management, and sales. Yeah, these are the three main. Different banks will have different ways of looking at it, but these are the three main functions within or businesses within the business that contribute to the treasury's bottom line. Okay, trading, sales, and asset and liability management. In some markets, they are called head of treasury is called head of FICC. Have you all heard of that? FICC. Have you all heard of that? FICC means fixed income, commodities and currencies. Yeah. So now, why I mentioned that here is all what we discuss in Treasury, it will generate its income, managing all those things from retail by doing certain things, by managing certain asset classes. When you say asset classes, you're talking about basically certain types of assets you can invest in and trade and do business in. So you have fixed income, currencies, and commodities. So a treasurer, these are the three areas. Asset classes that you have will be fixed income, you have currencies, and you have commodities. Now, all these three asset classes have their own little variance. So fixed income will be government, corporate, fixed income, or whatever it might be. Currencies will be your local, foreign crosses, right? All kinds of stuff. Commodities will be gold, oil, whatever, copper, whatever the commodities you are allowed to trade. Yeah. So now these are the asset classes, these are the functions. Now what will happen is the trading desk will decide, I'm going to trade fixed income. The sales desk will say, I'm going to sell fixed income. The ALM desk will say, in order for me to balance to manage my balance sheet, I'm going to use fixed income. The sales desk will say, okay, I'm going to sell currencies to my customer. Fixed income trading desk will say, okay, I'm going to trade in euro dollar. Okay. Trading desk will say, I'm going to manage my commodities, run a trading for commodities. The sales desk will say, I'm going to sell commodities to my client who have a risk in terms of hedging their gold position, for example. Yeah. These two guys will speak to each other, these guys will speak to each other, all that internally will also happen. But all these three functions will deal in different ways with their clients in these particular asset classes, fixed income, currencies, and commodities. Yeah. Now, the question is, what are the tools we used? So we know the asset classes that are dealt in. Now, within those asset classes, they will use different tools to basically achieve its objective, which is profitability and managing risk. Simple as that. Yeah? So what are the tools? They will structure the balance sheet in such a way that you have a effective cash flow and you make your income from the way you manage your mismatches and gaps and so on. You will get into trading positions, and you will use products that basically you do forwards, you will do swaps, you will do asset swaps, you will do all kinds of stuff like that to get into trading positions that make you money. You will sell forwards, you will sell derivatives, you will basically sell spot dollars for your clients to achieve your objectives. So the tools will be the products used to execute on all of these asset classes, which could be swaps, which could be forwards, which could be options. ALM could use forwards, invest in fixed income, corporate debt. Sales could do the same. They could do swaps, forwards, FRAs, interest rate swaps, so on and so on and so on. So these become the conduit, the byproduct or the mechanism in which these products are used to generate P&L and risk management. Is that clear? Now, I'll just touch on one more thing. You said view on rates, you said ALCO, you said transfer pricing, right? ALM would say, okay, this is my transfer pricing mechanism for FX and for my interest rate. Yes, so that's done. That decision is made here. ALCO, you will have that debate around whether that should be changed or what the situation is right now. So all that is part of the management structure, right? Effective cash flow manager we touched on. Basically, that helps you generate money. View on rates, definitely yes. Now the view on rates, whether it should be rates in terms of interest as well as FX. Yeah. How does that impact here? These tools here. The view on rates will determine what of these products you will offer your clients and what of these products the bank could enter into at a given point in time. Interest rates are going up, we do this. Interest rates are going down, we do this. Foreign exchange rates are going up, we do this. Foreign exchange rates are going down, we do this. It's going to stay the same. What do we do then? Those views will help you monetize your products in a way that can maximize your profit and manages the risk of the bank. Are you clear about the sequence on how it works? If you're not clear, please do ask. Yes or no? Anybody? You're not gone for lunch, no? You're still there, right? Hello? Hello?
Yes, sir, it's clear, sir. It's clear.
Clear. Okay, because if there are any doubts, please ask, but I won't be touching this area again next week. So if you all need to ask any questions, please do ask. Even if it's from the material, I'm not gone through it like I said earlier. But if you want to go through anything specific around this area from the material, please do ask. Okay, right. Let's go to the next one. We've touched a little bit on it a little bit before. The objective of the pool rate is to what? We touched on it a little before. What's the objective of setting a pool rate? What's the objective of setting a pool rate? So pool rate is basically part of the transfer pricing rate, policy. Why do we have it in place? We've discussed it a bit. We've discussed it now already, but why do we have it in place? Why do you have pool rate in place?
To ensure that we are financing at a market rate.
Okay. Okay. What else?
To determine our cost of funds.
Good. Okay. Cost of funds, value of funds. Yes, correct. Yeah. So basically, you're right, to make sure that you're funding at a market rate and that we have a cost of funds, value of funds. It also gives the businesses, the credit guys and the lending, retail guys, the confidence to know where their rates are at a given point in time. Because if not, if you don't have a pool rate, every single deposit you go and take, you will have to go out there and ask, okay, what can I lend at now? What can I borrow at now? What can I borrow at now? Right? Or when I'm lending, what can I lend at now? What can I lend? When there's a pool rate, Treasury has basically said, look, based on the risk profile of the bank, funding requirements of the bank, based on the market rate right now, based on where we should be raising a rate, I think this is where we can take your deposits at and we can give you loans at. So then that's very clear. There is no, it's very transparent, it's very open, there's a governance structure around it, and you know what you should be sort of benchmarking it against. Now, where the pool rate differs significantly from where a market rate might be. So, for example, your treasury guy could be giving you a pool rate of say 5% or 7%, and then suddenly customer comes and tells you, look, I put a deposit at this bank for 1 month at 10%. You go back to treasury guy, say, look, you're giving me 7%. That guy, my customer, tells me that he's getting 10% at this other bank. So obviously, then there's a challenge to the treasury guy as to why the rate is lower. Then he can always say, look, yes, but I'm taking it at 7. I'm also lending at 7.5 or whatever the pool rate might be, right? Which shows that my loans are more attractive than my deposits because I don't need the funding. And you can tell your client, unfortunately, this is what we can pay you, but we can give him a loan for a much cheaper rate. So then what is the objective? The objective is to grow assets in that particular scenario. So that has to be very clear. And unfortunately, every time the bank's objectives are not going to be conducive to every part of the bank. Basically, it might be conducive to, say, the guys doing liability, the deposits at one time. It might be conducive to the guys doing the loans at one time. Very rarely will it be conducive to all parts of the bank as well. But the objective of the pool rate is to make sure that there is a transparent market-driven rate that is available that reflects the internal funding and internal requirements of the bank also in that particular rate. To 26, we've already done. Treasury passes funds along with the prevailing rate to corporate banking and to basically the guys who are lending in retail and corporate. Transfer pool has to be marginal, which means it must be what? What's the purpose of the it being marginal? What does that mean? I think somebody answered this question earlier today. What's the purpose of the transfer pricing pool being marginal? The pool rate being marginal?
It will attract the customers, like.
Okay, attract what customers? You're talking about new customers, right? Or retaining your existing ones with a new deposit, not the ones that you have already deposited. Sorry?
New customers.
Yes. So what I'm trying to say by marginal here is, look, you have an existing portfolio. You know exactly where the your existing portfolio's funding rate is and where you have lent at, etc., etc. All that is there. The transfer pool rate has to be marginal, means that, look, if you are attracting a single new dollar or you are lending a single new dollar or rupee or whatever, right? What is the marginal rate at which you have to increase or decrease your rate by in order to attract that next new bit of money, or deploy that new bit of money to your client side, to a new client? So it is the next. That's what he tried to say. Look, it doesn't mean that you take your rate from 6 to 7% just because you feel that you need to raise deposits. It means, okay, if I need to increase it $1 extra from where I am now, marginally, what do I need to increase the rate by in that case, right? So that is a calculation based on your assumption of what that marginal increase is and what the marginal return based on that could be because you do that. Yeah, 28 we already answered. 29 also, okay, we answered it, but I'll ask you that question again. It is necessary to have the dealers in Treasury to execute what tasks? Now, I touched on that a bit at the back here. What are the tasks based on this that they have to execute? Day-to-day tasks. If you were going to audit the Treasury Department, or you're going to sort of look at a Treasury Department from a perspective of what evaluate their function and what they're doing, what do you think a typical daily task of a Treasury Department?
Manage bank's funding requirement.
Yes, correct.
And maintaining necessary liquidities, reserve requirement imposed by the regulator.
Yes, very good. That's correct. What else?
Look for new opportunities where you can maximize your profit by
Who would
investing.
do? Which section would do that?
Basically, ALM.
ALM, trading as well as sales, no?
Yes.
Because
ALM.
ultimately trading also will have to look at new trading opportunities to make money. Sales will have to look at new products or new opportunities to do their clients as well. So you're right, but your answer is correct. Okay. What else?
Dealing.
Dealing would be what trading does, basically. So a trader would be a market maker or a market taker. A market maker would be somebody who will go out there proactively, make a price in the market and trade. A market taker will be who reacts to price that's given to him on a more reactionary basis, but we have both from a trading perspective. You also missed out on nostro account balance management. That's an important part of Treasury, where they manage the bank's requirements in terms of nostro dollars, yeah, and ensure that there's enough funding in that book as well. We discuss funding, but nostro account management and vostro accounts are another sort of area that Treasury looks at directly. Risk management includes interest rate risk management, foreign exchange risk management. If there's any other asset class they're dealing, risk managing those asset classes as well. In some cases, Treasury also has global markets as a what we call the research element that sits slightly outside of Treasurer's purview, but it's also an integral part of the function itself, because a lot of clients would ask for the bank's view in terms of the exchange, interest rates, or the commodities, and that has to be an independent view, but also of value addition the bank facilitates, which is slightly outside of the treasury function, but it's also a component of that to an extent. The other side of it is also it has to manage the bank's ability to deliver on the products that we have in a very efficient manner. So, for example, if there are client requirements for foreign exchange and that kind of thing, they have to figure out how they manage that in a very methodical manner. Electronification, ease of execution, making sure that documentation is correct with the relevant departments for that, all that. And more and more with the current regulations that are coming in, like in Sri Lanka's perspective in terms of imports and so on, there's a big role the Treasury is playing with the clients in terms of helping them understand what they can and can't do within the regulatory framework that that particular country sits in as well. And there's a lot, not only in Sri Lanka, but overseas as well. Where there has been a lot of changes to the environment that you're working in, and those changes have to be made understood to clients, and Treasury usually has that understanding because it's the products of the dealing and the market they're dealing. And that's why I said it's become more and more external, because there are a lot more conversations that Treasury guys have with customers now than 20 years ago, for example. So the question about is it necessary to have dealers in Treasury to execute what these tasks or what tasks? What do you think? Is it a necessity or not?
It's necessary, no?
Yeah. So can you automate everything? Can you automate, for example, fund management? Can you automate FX risk management? Can you automate all those things?
Everything cannot automate because certain decisions you need to make that need to involve in human intention.
That's right. Very good. And I think that's where you have to draw the line between execution and management. Meaning, if you have people sitting around and answering a phone call and just quoting somebody an exchange rate, and that been recorded on a system, that process, and I'm talking from personal experience from my teams, can be automated. Because if you have a means of, with current, massive technological innovations we've seen in the recent past, right? You can actually automate those kinds of functions. Yeah, you can execute things online through a platform quite easily, just about setting up the infrastructure for that. But once those executions are done and those systems are updated and the processes like the fix or interest rates or whatever the product is in a system, you have to sit down there as a treasurer, as a risk manager, as whoever, trader, and decide, what am I going to do with this? Am I going to buy more, sell more, go long, go short, go long term, go short term? That decision sits with the trader. Yes, there could be artificial intelligence and algorithms in the future that even make those decisions to that extent. Not saying no, but it can. You still need some sort of human intervention for that. The other part of it is also that because of the electronification and the sophistication coming in, may not necessarily be in Sri Lanka, but around the world, you find that the treasuries have always been pretty small departments, relatively small. You would have like 15 people, 20 people in a department, or maybe now my section has maybe 8 people, right, in the department, right? So you will find that with that automation process, those departments are not big; they're small. There are 1 or 2 people doing the jobs. That's it. No other big names are, no numbers are required, basically. So that's something that also needs to be looked at, because what happens with the Treasury Department, they make a significant amount of money with a little less amount of people because of the nature of the job. But you need people for that job, and you need to have people who have the knowledge and the experience and the expertise to do the job. But you can also look at how some of these tasks can be automated depending on the type of task those are. And I think, like I said, some of them, if this execution related, then those are something that can be sort of taken off from the daily task of a treasurer. Is anybody working in a treasury? Sorry, I can't remember, but is there anybody in the group who is working in a treasury right now? I remember there were some people from audit and risk and things like that, but nobody from treasury, right? Okay. Right. Okay. So it's 12 o'clock. I'll stop there. I'm not going to go on till 12:30 because we've finished those 2 areas. I don't want to start the other section right now. So what I would tell you to do is the questions that we didn't touch on today, please try your hand at it at home. And next week, we will touch on the ALM side of things. And if there are any gaps in what we did today, we will try and fill it. I'll probably go through the presentations on ALM with you to do that part of it, and then touch on some of these questions that are here. Please do ask any questions, even from today's lesson, if you want me to retouch on something next week. Happy to do that as well. But please come prepared with your questions, because I don't want to go through the presentations in total again. But I need your questions, because if not, it is tough to figure out how much of this you all are understanding and so on. So it's very important that we get some feedback from you as well. Yeah. Any questions before I close up for the day? It's 12 o'clock now. So
Sir, since you touched earlier also.
Yeah.
Hello, sir.
Yes,
do you hear me?
Yes. Ramanaka, right? Go ahead. Yeah.
Sir, I'm Niaz, sir.
Yeah,
Since you already touched on this Nostro and Vostro. Is it possible to explain that briefly with an example?
Sure. So, what is a bank's Nostro account? A bank's Nostro account is where it has account with another bank, basically, and where it basically has to manage the funds in that bank in that particular currency. So, for example, we'll take the most common one, US dollars, right? The bank concerned will have a US dollar account in New York for its purposes of clearing US dollars. So, for example, if you have an importer who has to pay $100,000 to a customer sitting in, we say, London, now because he's paying dollars, what will the bank do? Bank will say, okay, fine, I have to pay you have to pay $100,000. How are you going to pay those dollars? The customer says, okay, I'm going to convert rupees into dollars and basically then be able to, I'll buy the dollars from you. So the bank, local bank in Sri Lanka will say Bank of Ceylon. He is an authorized dealer. The Bank of Ceylon guy will say, okay, I'll sell you $100,000. He'll take the customer's rupees. He will buy dollars from the customer. Customer's rupees get debited. US dollars are there. Now the US dollars are sitting at the moment with the bank, with Bank of Ceylon. Where are the dollars? It's sitting in a Nostro account, which is basically Bank of Ceylon's own dollar account they have in New York for the purpose of paying their dollar obligations. Sometimes Bank of Ceylon may not have enough dollars in their Nostro account because the Nostro account has to be managed dynamically. So what does Bank of Ceylon have to do then? They take their rupees that they got from the client, they go out into the foreign exchange market in Sri Lanka and say, look, I need to buy $100,000. They come to Standard Chartered Bank and say, okay, Standard Chartered, what's your rate for $100,000? They say, I'm selling dollars at 100 and whatever the rate. Okay, that's mine. They say, they buy $100,000. What does Standard Chartered then do? They'll take the rupees from Bank of Ceylon and they will send the $100,000 to Bank of Ceylon's Nostro account. Now, Bank of Ceylon has $100,000 in their Nostro. They also have a commitment to pay $100,000 on behalf of their importer. What will they do? Now, they have the $100,000. It sits in New York. The importer wants somebody in UK to get paid. He has already given instructions to Bank of Ceylon as to where he wants to deliver his dollars. Bank of Ceylon will debit their Nostro and pay the importer's particular account, UK importer's account. So UK importer might have, Barclays Bank, for example, as their bank, and they will say, our guy will say, look, pay to my clients this Barclays account. Bank of Ceylon will then pay that to Barclays Bank Nostro account. Now that's the process. Now to do all this, the management of the Nostro balances that sit in that account, how much of funds I need to do this process, whether I need to borrow money into my Nostro account, whether I need to buy foreign exchange, convert foreign exchange and fund my Nostro, whatever the process, way of doing it, that sits with Treasury as to how you manage your Nostro account. Okay. Vostro accounts are basically where a foreign entity will have an account with you in your local currencies. So the opposite of Nostro. So for example, if I give you an example, would be, we'll say a foreign bank, like we say JP Morgan or somebody like that, bank. They don't have a presence in Sri Lanka, but they will have a rupee Vostro account, meaning they have an account in Sri Lanka in Sri Lankan rupees with a bank in Sri Lanka. They could have it with HSBC, they could have it with Standard Chartered, they could have it with whoever they want. Those guys will use that particular account. So that is their Nostro, our Vostro. Yeah. For them, it's a Nostro account. For us, it's a Vostro account. They will use our Vostro basically to their Vostro with us to basically fund their rupee requirements. So, for example, they buy a government security. They will basically say, okay, I have money in my Vostro account. Please transfer that money into a IIA account or whatever it is, and then purchase the foreign fixed income security for me. Or they will come and they will do a foreign exchange transaction, convert dollars into rupees. Dollars we will get through their dollar accounts, and then convert those dollars, and we will park the rupees in that Vostro account and then convert it and put it into wherever they want us to put the rupees into. Yeah. So that process of managing the foreign exchange, managing the money that goes into the Vostro, not the account entries, but ensuring that that process happens and ensuring that Nostro has sufficient funds in the account to meet our trade obligations, our payments obligations, etc., etc. And at the same time, optimizing the money in that. Meaning, you don't want to have $10 million sitting on your Nostro account because you feel you're going to have payments. That's not dynamically managed, because you're going to get paid nothing for that. You're going to get paid like 0% interest. So you need to manage it in such a way to just the right amount to meet your obligations, but not too much to be taken to task for not having the ability to maximize on your returns on the dollars that you're keeping there. So that process is what Treasury does basically. Thank you for the question.
Thanks for the clarification, sir. Thank you.
Any other questions? Okay, great. So then like I said, I'll stop there for the moment. I think we've covered the main questions that I have put down there on that particular area. And we'll start next week, 8:30 again. And like I said, we should be able to go through the ALM bit and touch on this if you require to again as well. Please do go through your work, go through any extra content you have. If you have any doubt or anything, just drop a note to the institute. And if there are any other questions that you have, happy to answer that also in between for you as well.
So can I ask a question related to the exam?
Please do, yes.
Yeah, now there will be 5 questions which we have to select 3 to answer in the basically the second part.
Yeah.
Will there be a question from the ALM part out of those 5?
There will be a ALM question, yes, as well. Yeah.
Okay. Thank you, sir.